if it's not too cheeky, I wanted to get a bit of a sense of who's in the room. How many entrepreneurs do we have in the room? That's manufacturers, distributors, people that are running cook stove businesses? Okay, it's about 15 maybe. How many funders are in the room that are funding cook stove companies? Okay, so the majority are researchers, academics, NGOs. Okay, so I got a pretty broad spread of audience here, and not dominated by any one group. So that makes my life really quite difficult. So, just by way of introduction, the Shell Foundation is an independent UK registered charity, and our mission in life is to co-create and foster the growth of social enterprises to tackle some of the world's big global development challenges. And we focus on three themes. One is access to energy, one is mobility, another one is SME finance. So that's who we are. Firstly, could I say, first of all, thank you to GAC for the Alliance for having me, and I have to say, and to Radha and her team, I read the report on the way over. It's pretty impressive what the Alliance is doing. Having come from a background where I worked in water and sanitation, I'm not an oil and gas person, I'm a wash person. And having worked in multi-stakeholder membership organizations, I know what a challenge it is to get stuff done when you're trying to marry and juggle with the interests of, in your case, hundreds of different organizations with different agendas and different interests. So it's not an easy job what the Alliance is trying to do, and I think hats off to you and the team in terms of what you're doing to build the industry and build the market, which I think is very impressive. In terms of the foundation, the Shell Foundation, and I'm speaking really to the reflected glory of my predecessors, because none of this is my work, but I can give you a couple of comments of what the foundation's learned with regard to financing the sector. The first is that the foundation started in this business about probably 10 to 12 years ago, and started by taking a very fragmented approach to inviting calls for proposals from many different organizations, and found that providing small dollops of grant funding to large numbers of organizations, whilst being value added, wasn't getting any of the single organizations to any degree of scale. So they took a very conscious decision to try and focus on one, to get really some degree of scale across different countries, to get some, if you like, more attractive company and a more investable company to try and crowd in some private capital. So that's what the foundation's been doing, I think, for the last probably 5 to 7 years with its principal partner, EnviroFit. And within the context of the sector, we will have to be very modest. So I think there's 5% penetration still in terms of the total demand. So we're still all very small. And we as the Shell Foundation are also very small. I was impressed by the 80% of the funding coming from DFIs and banks. And philanthropy is tiny. So we're all pretty small in this space. But I think what EnviroFit's achieved with its millionth stove is the beginning of something which can attract some more commercial capital. That's important. So where do we stand now in terms of the foundation? We've been very much working closely with EnviroFit. We have now the company has reached a certain scale. We got to the point where we thought, well, how much longer do you provide grant support to an organization which is already becoming commercial? And there's going to be a point where it begins to distort the market. So we very consciously, at the same time, we were going around helping EnviroFit raise funds, and we found that people were still very, very nervous to invest because there was a perception of this being not an investable market. And that perception is still there. So having had one unsuccessful round of fundraising, we then decided to invest ourselves as an equity investor. So Shell Foundation is now an equity investor in EnviroFit. We are no longer a grant funder of EnviroFit because we believe that it's important that EnviroFit is now effectively funding its own growth. It has established a certain level of credibility with its investors and with its funders, and our job is to try and catalyze other investors into that company. So it's an important message, I think, for the Alliance generally and the people in this room to know that we've stepped back from being a grant funder in EnviroFit. We're obviously very good and close friends, and we will continue to be over the next years. But we are now an investor. We are now an equity investor in the company. And the reason for that is that we are desperately trying to build confidence in this sector. And that's, for us, the best way we think we can do it. So one of the first message, and then I'll be quiet, but the first message I wanted to leave is to say, if you think about the coffee market, or the coffee shop market, what do you think would happen if Starbucks started going under? The first thing would happen would be that all the financiers of Costa, Nero, Pret would start getting very worried and probably stop funding those companies. So our sense, and this is really why I think the Shell Foundation supported one entity particularly for the last 8 years, our sense is that this sector needs a market leader, who's done the hard work, done the pioneering work, and is actually able to demonstrate to the funders outside the sector that this is a credible and investable sector. So I would strongly encourage, as we step back in the foundation, I would strongly encourage you to embrace EnviroFit particularly in terms of your support and your endorsement, because it's vital, I think, for all players in the sector that EnviroFit succeeds. Because the moment EnviroFit catches a cold, believe you me, everyone will catch a cold. And this is, I think, a pretty important, this is a deal that I'm making with you now as we pull back, that you guys embrace this team. I think it's really important that you celebrate the success of the Million Stoves, and then you continue to see their success as your success. And in terms of what the foundation is looking to do, we believe that the most useful thing we can do now is to think about how we can support the wider market in terms of all players. And probably the most useful way we can do that is to increase the number of financial facilities there are available to all players in the market. And we're seeing big opportunities, catalytic opportunities around things like consumer finance. So if you can actually finance people's balance sheets in terms of customer receivables, credit assessment, if financiers actually see more visibility on the credit worthiness of clients, we think that's could be transformational. And thirdly, we've already set up a working capital fund, but there could be a lot more. There needs to be tens and hundreds of millions more available in terms of working capital for the distribution, for the manufacturing, and for the operators' pipeline in terms of their working capital. So, and finally, impact monetization. We're testing various ways of actually leveraging government money in being able to sell impact after it's been delivered. And obviously carbon finance, and Jeroen will tell you more about that. So financial intermediaries for us is very much an area we think we can help the sector, very much looking across all of the players and trying to help Radha and her team bringing what we can, which again is pretty small given what's needed for the whole market to try and float all the boats. Thanks.
Excellent. Thanks very much, Sam. Gemma, let's turn to DFID. If you could say a bit about DFID's engagement in the sector, especially in this area of financing.
Thanks, Brian. It's a real pleasure to be here today, so thank you to the Alliance, all the team, for the opportunity for DFID to be present today. As a donor, we really recognise the critical importance of access to clean energy and to address energy poverty and these cross-cutting nature for health benefits, environment benefits, gender benefits that we've all heard about today and we continue to discuss. I'd say that DFID has been working in the sector particularly over the last 4 years and is a really proud supporter of the work of the Global Alliance Secretariat as it's got established. Leaders like the Shell Foundation have been critical to us engaging in that. And we focused a lot of our initial work on research and evidence provision, trying to help get the evidence behind the supply chain needs, the demand creation, and the enabling environment. And most of our funding to date has been around grant financing. Some of that funding has gone into some of the funding, the mechanisms that have helped some of the startups to grow, Women's Economic Empowerment Fund and others I know of. And in the last couple of years, we've been looking to see if we can expand that. And we were very pleased to announce additional funding to the sector as a whole last year that showed our commitment to that in quite substantial terms, both to the Alliance itself, but also to the sector as a whole. We are very, very keen to ensure that our mix of support is quite broad, quite wide-ranging, doesn't necessarily pick winners at the moment. And right now we have a substantial program of support on stove technologies and fuels, particularly in Africa, targeting those different market failures, the geographies and subsectors. And we're able to match that quite well onto the Alliance's main areas: increasing demand, strengthening supply, and improving the enabling environment, but trying to scale that up through a variety of financing mechanisms. Mostly, as I've said, that's grant funding, seed capital for many enterprises through challenge funds. Perhaps some of you might have received funding from REACT in East Africa, also the Energy Environment Partnership operating in South Africa. Also, thanks. Also, innovation prizes that GVEP so kindly talked about yesterday, and increasingly results-based financing. Some of you might hear a little bit more about that later this afternoon. And we are very much looking at increasing our options into kind of working capital that we hear as an absolute desperate need for many of you, and it's been flagged by Sam. We haven't quite managed to land that in the clean cooking sector yet, but it's still very much in play. I may talk a little bit later on impact investing, which is a smaller piece.
Great, thank you very much. Lasse, let's turn to IFC. Really the same question. Your perspective on the sector and IFC's engagement within the sector.
Yeah, thank you very much. And first of all, thanks to the organizers for inviting IFC. And then congratulations on a great study, Stephen. I thought it was very interesting. IFC is a part of the World Bank Group. For those who don't know, we work with the private sector, and the World Bank works with the public sector. So it's important to keep that distinction in mind. IFC is as we all are clearly concerned about the health problems with primitive cooking around the world. So there's no question about the why. It's how IFC should engage that we are exploring, to be very frank and very honest. This is a difficult sector for IFC to engage in for a number of reasons that I think was pointed out before. One of which is the size of the companies. Not that we need to see very big tickets, but the transactions cost of processing very small loans makes this sometimes almost impossible for IFC to invest. What you do then is that you try to set up some type of intermediary arrangement. So maybe you work through local banks to provide a credit line, or maybe you can even provide equity in smaller pieces through intermediaries. The IFC experience in this space has been quite mixed, to be honest. We have invested equity in a few carbon projects, so where we basically financed the technology and their companies made money by selling the carbon credits. One of these projects is here in Uganda, one is in Malawi, and one is in Nigeria. And this is actually a pretty big step for a bank like ours to put our own money in there. It's our own balance sheet. It's not donor money. It's our own money. So if the company is not profitable, we're going to lose the money. We are also invested, I believe, 8 million in the Responsibility Energy Access Fund, which provides working capital. And as we saw in the presentation before, there's a great need for working capital in this space. This fund is primarily targeting lighting products, but there's also a window for cooking products, and which is the reason that the reason for the fund is we saw a very strong need for working capital. IFC has also looked at partial risk guarantees for banks, so banks stopping local banks that would lend to consumers. I have to say this is not an easy sell necessarily. Local banks, in addition to the very high interest rates that we heard about yesterday, banks need to be very comfortable about technology. They want to be sure that the cook stoves are actually going to work, because if they don't, it's very likely people are going to default on the loans. So if we have a situation where we don't have a good track record for the technology, it might be very difficult to get the bank involved, or they want a lot of protection. And we have seen that in some of the engagements we've had with banks. And it should be no surprise, and I know in the audience from the great seminars yesterday, there are many folks who are aware of this. So what we would be doing is we would be backstopping the local bank. So if there were people did not repay the loans, we would then step in and help the bank to mitigate their losses. We have also looked at LPG in Kenya and Nairobi. There we had some operational issues with the technology. And this is a theme in all of this. If the technology is not robust, if it doesn't perform well, or there's a lot of concern. And we are still pursuing LPG, and this was for bottom of the pyramid consumers. It's a great technology, but there were some issues regardless. Another issue for IFC, and it shouldn't be a long list of complaints, but another issue is just the general fragmentation in the sector. The companies are very different, and their experiences are very different. And their management experience might not always be what investors are looking for, and that will not just be IFC, but any investor. You want to see a strong record in the team that is running the company. You want to see that financial folks are taking financial decisions. This is not an engineering company. This is a company that should be run profitable, and this is not always the case, and this is not surprising. But if we don't see this, it might be more difficult to get management support for making the investment in the company. I will maybe just stop it there, but I want to emphasize that this is an area where we are still learning, and we are very open to any input and from yourselves to understand what are the needs for financing, and studies such as we heard about before are really helpful. You know, it's not enough that we just hear there's lack of access to finance. It's a need. We need to find out and work together. What are the products exactly that are needed? Is it a facility like the one we saw before? Is it an equity finance, the equity bid? Is that what's needed? I personally have doubts you would find equity investors who would come in there. It might be more philanthropic or concessional grant money, because we probably have to realize this is perceived as a very high-risk sector. And in order to step into a high-risk space, you want to have high returns. And this is not something we can always see with the Cook Stove. If you look at the business plan for the company, it doesn't have this amazing exponential growth curve. So it's going to really reward investors. They're going to get returns 30% or more within a couple of years. As you also have seen in the lighting space, this is not the type of space. And that relates to another issue, which is about the cost structure. We think it's difficult maybe to drive down the cost significantly through mass production and scaling. We're not quite sure, but we hope so, and we're interested in hearing their experiences in this area. EcoZoom yesterday had a presentation, is how they ramped up their output significantly. It would be interesting to know what that meant in terms of cost per unit. Maybe they were able to drive down the cost. So I'm going to finish with that, and thanks again to the organizers.
All right, thank you very much. Godfrey, you represent an organization also that has made investments in Cook Stove Enterprises. Yesterday, I think in that very chair that you're sitting in, Boston from Bern made the observation that historically the investors have been out in front of the enterprises in the respect that there's been more investment dollars potentially available than could be absorbed by the sector. I'm curious on your perspective of whether that is changing, what the opportunities look like.
Okay, thank you very much for the invitation. In terms of background, Acumen is a social impact fund, and what we do is that we raise philanthropic money and we invest in social enterprises that provide critical goods and services to the bottom of the pyramid. We're 14 years old, and we've deployed over $90 million in 6 sectors. And energy is one of the critical sectors that we've invested in. Like you said, Ben is one of the companies that we've invested in. We have BioLite, and in fact, we are just about concluding a transaction in Nigeria. And I would say that though we've been investing in the Cook Stove business for the past couple of years, I would say we see enormous opportunities in that sector, but like they said, most of the businesses, the technologies are still in the developing stages. And usually, if you want to use commercial funding to support these businesses to trade, it's pretty difficult. And that's why within Acumen, we think that you can use philanthropy-backed money that is patient to allow the entrepreneur to iterate their business model, to perfect the business model in terms of the product type, the distribution model that they have. And often what we have seen is that whilst you are supporting the entrepreneur, there's also the consumer aspects of it. Because the bottom of the pyramid people will really should be able to afford. And in some cases, the outlay or the capital outlay that they need to put forward for a product is beyond their affordability. Therefore, you need to be very innovative in terms of coupling both on the investor side and the consumer side. Yes, I would say that because of the nascent nature of the industry, most of the times we see businesses, but they're probably in the preparation phase. We support businesses what we call the pioneer gap, and that gap is those in the testing and validation stage. What we do is that we try to work with business incubators and business advisory services companies that will be able to handhold the entrepreneur to help them put together the business in a form that is investable. But I would say the opportunities for financing for people who are in the energy space is growing, but it's often the case that when entrepreneurs come, they still haven't yet perfected the business model, and for you to use investable capital to support them is pretty difficult. But we recognize the potential that this sector holds, and in fact, within Acumen, we are trying to raise an energy-specific fund to really scale up our investment in the energy space, particularly in the cook stove business.
Okay, thank you very much, Godfrey. Jeroen, turning to you, you have a long experience in the sector, both with Shell Foundation and now with the BIGS Fund, and have perhaps a unique perspective or unique approach amongst the people on the stage. Could you tell us a bit about that?
Thank you. And yeah, I have to be a bit modest because we're still putting together a few nuts and bolts on our funding, which hopefully will all be there by the end of the year. So I'm speaking present tense, but I have to actually address future tense. But for ease of argument, I'll do present tense. Look, just briefly on where this all got started 5 years ago in 2010, and I remember the story that Suraj told yesterday on this stage, and all the exercises we went through with Radha and her team to shape this alliance. Thank you. And one of the observations I have at this halfway point is that in my opinion, the bankability of all those entrepreneurs that raised their hands on Sam's request, I think has gone up tremendously. It's a long-term perspective, but where we came from 5 years ago compared to where we're now, I see so many opportunities. And I've been talking and engaging with a lot of the people in the room that actually seek funding for their operations that are much closer to being eligible than a while back, and that really excites me. Now, what it is we're doing, I learned from 2 years of fundraising that if you have a potentially complicated business model, you have to make it really sound simple. So what we do is we provide finance to industry players in the value chain, based on secure future receivables from climate impacts and potentially other social impacts. So that's it, really simple. Truth is, there's a bit of hassle behind that. The whole carbon market is not what it was 5 years ago, but I think we're tremendously pleased with efforts from some of the sovereign buyers and the World Bank and the Swedes, and through World Bank also DFID, actually still maintaining that market for charismatic credits. And we're also very bullish about the future of alternative impact mechanisms. The Adaly was mentioned. There is opportunities in monetizing gender type impact, around time saved by women, and just generally result-based finance, I think is a very good opportunity for intermediaries like ourselves to play a bridge, to have a bridging role between donors on one side and the industry on the other side. So I think just as an introduction, should leave it there.
Thanks very much. We'll turn to questions from the audience in just a second, but we didn't give any of you a chance to ask questions or sort of express an opinion about the presentation that Stephen made on behalf of the Alliance. And I'm just curious from the panelists what your perspective is on that. We present an analysis, we present a possible structure. What's your reaction to that? And specifically, where would you perhaps see your organization fitting into that structure? It's open to anyone who would like. We can all go all the way back down if Sam, or we start with Lasse. Yeah, please go ahead.
Yeah. As I said, a very interesting presentation. I was wondering about the pipeline. I was wondering what would be their investee companies. Certainly if IFC sets up a fund, you want to deploy the fund pretty quickly, and thus, as part of the whole due diligence, you do the due diligence on the pipeline, so that money can be spent. This is a common, almost self-evident, I think, truth in financing, and so the sizing of the fund, I think, very much comes from the viability of the pipeline, and there wasn't time to get into it, but I think this is something we would be asking about. And then, so sometimes their experience really is, let's first do some single companies, some single investments, and then we can put up a fund instead of doing it the other way around. That who says it's a need for 100 million? How do you know? And if this fund sits around for several years, the money, the alternative, the opportunity costs are quite significant. It could be used for other very important social purposes, and so that was just one quick observation that it would be good to hear about, actually.
Yeah, thanks, Stephen. Did you want to address that? Or? Yeah.
Hi. Yes, this works. Great. And also, you had the point earlier, Lasse, about this being high risk, and are you really going to be able to raise that equity money? And I think these are very, very important and relevant questions that we have spent and are still spending a lot of time thinking about. I think on that question, yes, that perception is there. I do think that is improving. I think you'll find that is why, as you recall, when we talk about the equity, we really just target that at the larger end of the spectrum, the larger companies. And I think thirdly, the way you deal with this is really, again, by going through these intermediaries. So people who are closer to this business, who know them well, who know the environment much better than we could. And again, I think that also talks to your point about pipeline. If we were going to be sitting in London or DC, wherever, trying to generate that pipeline, that's potentially not going to be all that effective. Whereas if you have people locally who are much better able to diligence these opportunities and access them, that we feel is very much the way to go. I think on your last question, does it make sense to start small and scale it up? The problem that you always have with these things, and even though I said this has been designed as kind of a very lean cost structure type of setup, there's still an amount of cost and effort involved, and it is very difficult to do that, I think, and to make the numbers work if you do that at small sums of money. I also think, just given the importance of the issue, the way the sector is developing, I think it makes sense to be a bit ambitious. And again, it's by finding the right structure, getting the right kind of people involved across the wide geographies, across the sector, based on the work that we've done and the many people we've spoken with. the opportunities are there. It's just a matter of finding the right way to manage them.
Okay, thanks, Stephen. Jeroen, you had your hand up. Yeah.
Two quick questions for Stephen, and they might sound self-serving, but they're not intended to be like that. So the first question is, you clearly distinguish between equity and debt, which makes a lot of sense, but I think the needs in the sector might be a bit more diverse, and you might need to broaden the scope a little bit to the more innovative structures. So here is my self-serving argument for a more innovative component of that as well. But the other question is, if I understand correctly, you want to pick your intermediaries at the beginning and work with them along the way. Do you foresee a process where you actually, where it becomes flexible, who to work with, actually a sort of a selection process of new intermediaries emerging over time, a little bit in comparison of what the Dutch Good Growth Fund is doing in the Netherlands? Or do you really see this as a sort of starting with a group of intermediaries that you're going to take along for the entire ride?
Again, very good points. I think first of all, obviously I had I think about 7 slides, and there's a bit more kind of thought and detail behind it, and you're absolutely right. I think the days where you could take debt or equity and otherwise forget it, those days are over. I think we're past that. So in the detail, we do envisage more kind of hybrid forms clearly being a part of that, especially in this kind of environment. You can't do without. So you're absolutely right. In terms of selecting the intermediaries, I think the way we look at it, it would be good to have a roster of intermediaries lined up at the start. And effectively, that is what you go to investors with, right? So these are the people you're putting your money behind. And you're expecting that to stay relatively stable. Right? Does that mean that you would not take on a new intermediary if that made a lot of sense, or if another intermediary disappeared for whatever reason, or... Of course not. I think there will be flexibility. It's just around creating the governance then, who takes those decisions, and is that transparent? And
Thanks. Godfrey, please.
Maybe a couple of comments. They are not questions, though. I think 100 million and the work that we've done in this space, are we ambitious enough in terms of saying 100 million will move the needle in trying to make this sector one of the, make the impact that we are envisaging? The second comment is also in terms of the equity debt component. The caution should be on the equity side, you should really be modest in your expectations in terms of hurdle rates, because people may come with the typical private equity mentality that, I need a hurdle rate of 10%, but within the sectors and the people that we want to serve, that's a hurdle rate of 10% make you and on the debt side, the caution also is, this is a global, a global SPV, and in most of the countries that we are operating in, exchange rate issues is critical. And when you give dollars to, say, a commercial bank in Ghana, who bears the exchange rate risk, particularly if they have to lend to a local entity? And then my last comment is, I think maybe the facility should be focusing on the B's and the C's, because the A's, particularly if you have over $1 million in terms of revenue, is pretty sizable. And many of these people should be able to graduate towards commercial capital. The only issue is always the B's and C's, where people don't see the trees from the woods.
Okay, thanks very much. On the question of ambition, it's dangerous to invite these guys up on the stage. Yesterday, David Martin doubled the objective for the sector from 100 million to 200 million stoves. Today, we're doubling the amount of capital we need to drive into the sector from 100 to something more ambitious. Okay, right. Thank you. Sam, please go ahead.
Yes, just firstly, absolutely right for the Alliance to be thinking about financing, and we need to massively increase finance availability for the sector. I still feel there's a sort of disconnect in this conversation, and I think the disconnect is that we don't acknowledge the role of grant funding and the importance of the role of grant funding. And to some degree, we think it's incompatible with the idea of market-based solutions. It's absolutely not incompatible. Amazon, I think, was 12 years before it was profitable, and yet they piled money into parts of the business, and people were willing to fund it. Boeing was the same thing. If Microsoft sets up a new line of business, it will fund it, it will subsidize it for years, and yet we expect these nascent markets, these nascent sectors to be immediately profitable. We have to grow up and realize that these sectors take decades, and these businesses take decades, and a lot of grant subsidy to get them to a stage where these investors will actually invest. And we can't be pie in the sky about this mysterious group of investors that are sort of waiting in the wings. Investors, and you've heard from one of them today, the investors look for returns, and they look for low risk. Believe me, a $1 million business is still not attractive for the big money. Still not attractive. It's too small. They might negotiate some. We found, to our shock, that some of the businesses that we've invested, firstly, outside of in the energy sector totally, we found that it takes between $5 and $20 million of grant funding to get a business to scale, to a reasonably investable scale. That's a lot of money. And companies won't come in at the $1 million level. And if you're going to get people to be from the 80% of the finance, which is going to get you to your $200, $300 million, somehow we have to answer this elephant in the room, which is, where is that grant funding going to come from? And are the institutional financiers actually willing to assign $50 of grant to get businesses to be investable in order for them to actually invest finance to buy into those companies? If we don't answer that question, we'll be here in 5 years' time still talking about the $200 million.
Really good point about the role of grant funding, and I'd like to turn to Gemma as well. Obviously, DFID provides a lot of grant funding in this sector around building the enabling environment, more recently now in enhancing demand. I'm curious on your perspective about this type of structure that we're talking about and how DFID might engage in that.
Tricky question, thanks. I'm going to give a civil servant's answer. Thanks for the comment about grant funding. We're really keen to continue our grant funding, and we are, and that is the message that we're giving out. We hope in the years ahead that there'll be more coming on stream, and watch this space, and we'll always use the alliance mechanism to communicate with eligible enterprises to access that. On working capital, as I mentioned before, we've been really keen to try and invest in areas like responsibility and other things, but from our own internal processes at the moment, we just haven't found the right place to land it. I go back again to London with a very clear message: working capital from 500,000 up is absolutely necessary for this sector, and we need to do something about it.
All right, thanks very much. We're running a little bit over. We did start late. I do want to turn to just give the audience an opportunity to ask a few questions. So if we could perhaps go just to maybe another 7, 8 minutes. Let's start. Plenty of hands in the audience. Sure, please, go ahead.
Just want to pick up on something Sam said. So when I was listening to Stephen's presentation, I was thinking this. I mean, I started in the private sector. I worked 15 years at IFC. That's in my blood. But when I look at this sector and the amount of money that's being requested, if this was a global health sector, $100 million or $200 million is a fraction of what DFID puts into Gavi or into other public other public health areas. And so the issue there is they see a clear social benefit from that, but they don't expect a financial return from it. I think if we really want to address what Sam said and jumpstart the sector, it is to the credit of the Global Alliance in the sector that there is a real focus on on investing in private sector. But I sort of feel that the models that should be looked at for this facility are not to the private sector, because listening to everybody, it's not ready for that. let's make the case for the social benefit from this, from a health, from a climate change, from a forestry perspective, and use that to raise $100 million or $200 million from the sorts of investors who are used to putting that into public areas, and say, yes, if we can get you a financial return on this, we will, but the social benefit is worthwhile at this point to do it. I think if we, as Sam said, if we wait for the private sector to do this, and as the gentleman from IFC said, you'll be having the same conversation in 5 years.
Yeah, a really important observation. I mean, I come from a background working in global public health issues that do raise a lot more grant funding to advance the issue. I don't know if anyone wanted to address that, and then we'll turn to another question.
Hello? Yeah, this is working. Thank you for that question. Yes, I'm sure. I think that's right. Right? There's areas of the sector where you're not going to get there with private money. I agree. But I think what we're trying to do, and again, this is just one of a number of tools, a number of initiatives, is to, in some area of all this, to start crowding in the private sector money. And the idea is to create a structure that facilitates that. And again, that will require, as I said, grant money in a number of areas, whether it's around TA, whether it's around defraying transaction costs, etc. But you can still create an environment in which private or semi-private money has a place, and I think it's about trying to bridge that gap.
Great. We'll take another, please.
Hello. So the question is for the institutional investors in the room. When you think about addressable market, obviously scale counts, and I know a lot of people are very appliance focused in this room, but let's take the city of Accra. You know, the addressable market for appliances, stoves in this city, are maybe $5, maybe $10 million. Today, every year in Accra, there's $300 million worth of fuel that's consumed, right? So if we take off the appliance hat for the moment and think about addressable market and think about investment flows with a fuels lens, I'm really interested in particular your thoughts, Sam. You come from a vantage point of a fuels company, not an appliance company. You know, how do you think about this in a fuels perspective?
I have to fess up. I know nothing at all about oil and gas. So if you ask me a question about water and sanitation, I got a good chance. So I'm literally from the social enterprise sector, and so. My KPI is numbers of people reached with affordable modern energy. And this is one way to achieve that. So how we would look at selling this really to the wider investment, and our dream is to mobilize institutional investment into this sector. That will be our dream, and to help, do anything we can to help GAC, the Alliance, to achieve that. And our sense is that I was at the Vienna Forum, Energy Forum, I think, was it a few months ago, and the one indicator that's really lagging behind in terms of, they're all lagging behind actually, but the one that's most lagging behind is access to clean cooking. So how do you actually activate that? And our sense is it's much more about consumers and what they're, it's about what consumers want, understanding what consumers want, at what price points, and also offering them options where they can actually afford to pay over time is the key to this growth, the scale up of this sector. So whether you look at it from a fuels perspective or from a product perspective, in the end of the day, I think the consumer, when you sit down in somebody's house and ask people why they're buying stuff and why they're behaving in a certain way, how they're allocating their resources, it's more about the benefits they're getting in terms of time, in terms of ease of their cooking, plus the cost and the health aspects and so on. So for us, it would be a little bit risky or dangerous to be looking at it in terms of fuels, because in the end of the day, someone might come up with the most amazing, low-cost, effective cook stove in the market, which doesn't use any fuel, or uses a new type of fuel which we know nothing about. And wow, we would totally support that. So, great question. I'll go away and think about it. But there are big red flags there for me.
Just Sam, briefly building on what you're saying and in favor of your argument about fuels, if you think about it from a business model perspective, and that's, I mean, we have quite a few businesses in our pipeline The business of fuel is so much more robust for scale. If you just think about it, if you're trying to sell a cook stove to someone that's going to last for 3 to 5 years, you'll have to come back in 3 to 5 years and sell them another cook stove. In the meantime, there is no business with your consumer. Whereas if you're selling the fuel alongside it, you have a reason to go there on a weekly basis or on a daily basis, and you build a much stronger consumer relation. And I think in our business model, we recognize that as a very strong point in favor of the fuel-based models.
All right, thanks very much. I'm afraid we'll only have opportunity for one more question. Of course, there'll be opportunity after the session. Let's take way in the back there.
Hello, Matthias Olsson, Emerging Solutions. We are a fuel company producing pellets in Zambia and also institutional gasifying fan cooking stoves. And I want to first that we are a B company, and it's taken us a lot of struggle to get to B. And I want to address the C category because I know how hard it is to move from C to B. And my advice to the panel is to think of it in a way of maybe try to maybe aggregate companies, and because there will be a high risk, however you think about it, and the due diligence cost for a company needing 20,000 euros or 50,000 euros is going to be massive, and you cannot address that with traditional ways of managing risk. So put them all together, for example, and allow for massive failure rates. But if one EnviroFit comes out of that, could that be sufficient? So try to think out of the box, because you will not be able to address that otherwise. And also think of the companies which have not access to Western finance. Who in this room wants to borrow money at 30% interest rates and give land as a security? I mean, we have a Swedish company, we have a Zambian company, so we are in the best of both worlds. But I would not want to be in the position of being only access to African finance. So that's one advice I would give to you. Thank you.
Thank you. I think we'll need to end on that comment. It's a complex issue. As usual, we run out of time in these sorts of sessions to really probe it in depth. Of course, we continue the conversations outside the room. Yesterday, we talked about the diversity in the room, really in terms of just the number of countries represented. I think Sam asking people to raise hands at the beginning of this panel discussion showed some diversity in terms of the types of organizations, but you could dig down below that as well. Even within the enterprises, there's a great diversity. And amongst the investors, there's a diversity of interests and expectations about returns. So all of that makes the challenge that much more complex. Let's continue the conversation about that. I'd like a round of applause for our panelists. Thanks for joining us. Thanks. Enjoy the rest of your day.